not think we're going to go back to the 2023, 2004, or 2024 bull markets. We're joined now by Michael Green, Chief Investment Strategist at Simplify Asset Management. Michael, always great to talk to you, and thanks very much.
Andrew, always a pleasure. Thank you for having me.
So in the short term, you see markets doing okay, but we're not going back to those happy days of 2023, 2024, you don't think?
I think it's really hard to have that happen. The uncertainty that's been injected into the system, whether it's resolved by targeted tariffs that are on some countries, not on other countries, again, that's just uncertainty. Did you make the list? Did you not make the list? Where do I put my capital becomes an increasing question. I think all of us are trying to explain the move in markets today around fundamental signals, things like what Trump is indicating around tariffs. I'm going to actually take the other side of the equation and say that the most important thing that actually is happening today is what didn't happen last week, which is funds being pushed deeper into a position in which puts or option strategies that they had sold continue to constrain their capital. Option expiry on Friday was basically right up against that 10% S&P drawdown point that suggested that there was a ton of options that had actually come very close to at the money. Those were raising the risk characteristics of funds and forcing portfolio managers to be conservative. Now with that option expiry out of the way, additional risk-taking capacity has emerged, and we're attaching a fundamental signal to it as compared to recognizing that it's largely a systematic process at this point. We'll find out what happens with Trump on April 2nd. I'm much more concerned about that than the market would currently indicate.
Michael, just explain that again. What happened last week in relation to put options?
Sure. So one of the more popular strategies on Wall Street has been to enhance income by selling options. If you sell a put spread, for example, a very common structure would be to sell a down 10% put spread at the start of the quarter and buy. So you're buying the down 10%, or you're selling the down 10% and you're buying back, say, the down 20%. When you have a drawdown like this, that first option strike that you are short starts to go into the money. It's picked up a tremendous amount of exposure that raises the risk characteristics of those funds and forces them to be more conservative or even potentially unwind positions. Once those options expire out of the money, however, they can actually re-engage in risk taking. And I think that's really the biggest driver of what we're seeing today.
Right. Okay. So people are a little more risk appetite in the near term. You reckon that out there we're seeing national pride and nationalism replacing economic common sense?
Yeah, this is actually really interesting because it is one of the downsides to Trump's negotiating status or strategies in that it basically leads to people being very angry and resentful. So the U.S. is saying, we want to establish more fair trade. We're going to encourage you to do that by putting on punitive tariffs. The response to that could be one of two forms. We agree that the current regime needs to be replaced. Therefore, we'll move towards a freer system in which there's less restrictions. Or it can move in the opposite direction. Who are you to tell me what to do? And unfortunately, that's the direction that things seem to be headed. It's very much a cut your nose off to spite your face type framework, to use an expression from my grandfather.
Yeah, that's right. Or shooting yourself in the foot, I guess. But yeah, I do like that cutting your nose off one. That's an old one. U.S. inflation, you reckon, is still modest or quiescent, as you put it?
Yeah, my view on inflation is that it is quiescent, it is calm. What we are seeing in part is something that I had tagged last September, which is a seasonal component of inflation. If you think back to how prices were set in the period pre-pandemic, there was very little emphasis on raising prices at the turn of the new year to reflect increases in costs. As a result, when companies began doing that, it distorted the seasonality. That has meant that the fourth quarter and first quarter have been running far above the actual non-seasonally adjusted levels of inflation. And the same pattern, unfortunately, appears to be playing out. This is leading to confusion around the actual direction of inflation. Almost everything that we're seeing suggests that prices are very much under pressure and companies are raising prices, but very quickly discounting those as well.
Michael, you have spent a lot of time thinking about index investing. And of course, it's been a wonderful strategy just holding an S&P 500 index fund over the past few years. What are you concluding lately about the merits of index investing, just passive holding of all the big stocks?
Yeah, so this is actually a primary area of research for me. The key thing to recognize is that when you are index investing, when you are withholding from your paycheck to put money to work in the stock market on a regular basis, which the vast majority of Americans and an increasing fraction of the rest of the world does, you're changing the character of the market. You're introducing flows that do not say, what's happening to the economy or what is Trump doing? Instead, they simply say, do I have a job? And interestingly enough, those flows have the largest impact on the largest companies. The size of the orders that are being placed from passive flows into companies like NVIDIA or Microsoft or Apple are enough to actually cause those to rise regardless of underlying fundamentals. And so the market has largely ceased being a discounting mechanism in which it's trying to look at forward forecasts and bring those back to the present, and instead increasingly just reflects employment flows.
Oh. That's interesting. Yeah. So if people start losing their jobs, they'll start just stop just funneling money into indexes, and of course, yeah, and it becomes sorry, go ahead.
No, that's exactly the issue. It becomes self-fulfilling. The market basically continues to perform as long as people have jobs and that money is flowing in. That's interpreted by policymakers as everything is great. And as a result, we are less accommodative than we might be, or we're less serious about, say, targeted tariffs than we might otherwise be, interpreting the market as saying everything is fine. It's only once that begins to flow through to the real world economy that it has a meaningful impact on stock market performance.
We better jump, Michael. I hope you come back soon because you always bring up some new topics for